Well, thank you for the opportunity to speak with you today about investment management. As was described, I've spent really 30 years in the NGO nonprofit investment management, really 15 years at Harvard Management Company, a few years on the board of Commonfund, and then for the last 11 years at Commonfund. As Oleg said, it was an organization which was actually created by the Ford Foundation, which was, obviously you all are fairly familiar with the Ford Foundation since they help support your university, that really created Commonfund in 1971 with a grant to really be able to do the types of management of endowments that the large institutions were able to do. And so today we manage about 25 billion US dollars for about 1,500 endowments in the United States and Canada. And we've had a very successful run of 42 years and continue to look forward to the next 42 years. But I probably won't be there for those next 42 years. So I wanted to kind of start with some of the basic concepts that are really important when we think about long-term management. And when we're talking in the U.S., and I think really around the world, about endowments, and as I discussed earlier in the day at the legal forum, a number of countries around the world are trying to create a endowment model for their educational institutions and their foundations. And so one of the things we're seeing is that I spent a lot of time in China, where they're starting to raise money for their universities for endowments, Australia, as well as Japan, and the UK, who've all had a similar experience that you have in Russia of having largely state-funded, relatively free higher education. And as the state funding around the world becomes more tight and more restrictive, there is a lot of interest, and as universities are becoming more competitive worldwide for students, U.S. universities love students from outside the U.S., and what we're seeing is that institutions outside the United States are really trying to compete in terms of improving their level of education to be able to compete with some of the best U.S. education institutions. And to do that, a lot of them are thinking about raising endowments or trying to create endowment law. Now, it sounds like, based on what I understand, that in Russia it's relatively new. Having endowment law is only 7 years old. Foundation law is relatively new. But as a nation, you are still ahead of many of the nations of the world in terms of where you are legislatively. And that's, I think, important to recognize that the ball is starting to roll here in Russia, and clearly the U.S. has a head start on everybody else, but Russia has a head start on many other countries around the world, which you should feel proud of. So when we really talk in the U.S. about endowments, what we're really focused on is long-term. And what I mean by long-term is really the concept of perpetual, that endowments exist forever. So when money is given to a university, the concept for an endowment, the concept is that that money will exist and will support that institution forever, for eternity. And so when you look at the endowments in the U.S., for instance, of the large endowments, many of the contributions that have been made were made in the 1930s or the 1920s or the 1910. You even go back at places of some of the older universities to the 1750s. And so the money that was given in 1750 still exists in the endowment today. And so conceptually what you're trying to do is to create a methodology where you can spend a certain percentage of the endowment every year and keep the principal forever. And we refer to this in the U.S. as the key driving principle behind endowment management is what we call intergenerational equity. And if you look on the first page of your handout, page 1, This concept of intergenerational equity basically comes from work that was done by James Tobin at Yale University in the late 60s and early 70s, where he defined what the responsibility of endowment is and the trustees who oversee the endowment. And as you can see, I'll read it for those of you who are less fluent in English, as fluent as I am in Russian. The trustees of an endowed institution are guardians of the future against the claims of the present. Their task is to preserve equity among the generations. So conceptually, what does that mean? How do you preserve equity among the generations? Well, we've kind of translated that in terms of endowment management into a concept that you want to have the value of that original gift adjusted for inflation be constant. So if original gift was 100 rubles in 1950, the value of that original gift should be 100 rubles increased by the rate of inflation. So if inflation was 100%, you should have 200 rubles at the end of that 20-year, 30 or 40-year period. Now, in the meantime, what you're going to do is you're going to spend money off of that you're going to distribute a certain amount of dollars or a certain percentage of that endowment every year to operate, to fund the professorship, to fund the scholarship, to fund the operations of the institution. So conceptually, when you think about it, what you have is a pool of assets which, after spending, which tends to be around 5% of the principal value, grows at the rate of inflation. So the long-term goal in terms of generating a return on the endowment is your rate of inflation plus 5%. If you can generate inflation plus 5% in terms of your rate of return, you then ensure that you have intergenerational equity. If you have greater than 5% inflation, and you spend more than greater than 5% plus inflation return, you increase the value of your endowment in real terms. If you have less, you decrease the value. And so from the perspective of intergenerational equity, the first job of the endowment is to be able to generate a rate of return of inflation plus 5, which is very, very difficult to do. If you go to the next page, this is really a model. This is page 2. Page 3. This looks at a hypothetical.
У нас странички распечатаны по 2 слайда на одной странице, да? Вот номер странички внизу, то есть третья.
Oh, the 2 slides on.
That's fine. I'll go forward.
It's okay. For you, don't.
Okay. So in this slide, what it demonstrates is a hypothetical endowment which invested $100 in 1965 and returned 30% of the U.S. bond market and 70% of the U.S. stock market, and then spent 5% and was adjusted for inflation. So this is the picture of intergenerational equity from a U.S. perspective. If you had a 70-30 allocation between stocks and bonds, and you spent 5%, and you adjusted for inflation, at the end of this 46-year period, what you would have is $74. So let me ask you a question. Has this hypothetical endowment achieved intergenerational equity? You have 50% chance of being right on this one. No takers, huh? I thought I heard over here. The answer is no, right? It's no because the value of this $100 is now only worth $74 after taking into account the value of inflation and spending. And so, from the perspective of of the challenge that you have in terms of being able to achieve this balance, you can see from this slide, it is very difficult. And you really have to do things that are beyond simple investing to be able to achieve this long-term goal. Now, if you put all your money in cash, in bank deposits for this 46 years, how do you think you do? Much worse. You'll be down at about 40%, 30%. So conceptually, what this chart says is to achieve your long-term goals, you have to take risk. And even taking 70% of your exposure in the US stock market, you do not achieve your long-term goal. If you put 80% in US stocks, would you have achieved your long-term goal? No. 90%? No. 100%? No. So the key question as you think about endowment management is how do you invest your funds to achieve a long-term goal of inflation plus 5%. Now, one important point to this is that university inflation, the cost of running a university, is actually higher. The increase in the cost of running a university is actually higher than the consumer price index, than the rate of inflation. So in effect, if you would have adjusted the same chart for for higher education price index, the cost of running a university, you'd actually be at about 55 cents. So you would have lost 45% of your value. So this challenge of achieving intergenerational equity becomes enormously important. And it's very difficult to do. And it involves taking risk and making decisions about how to take that risk. I think I'm going to skip some of the next slides just for the sake of time. In any environment in which you have nonprofits, governance becomes one of the key aspects of how you go about doing it. And on page 4, we talk about some of the best practices for governance of nonprofits. Most nonprofits, NGOs in the US, are actually run by a board of trustees who are responsible for setting up the practices and policies. And they are, in effect, responsible for the job of achieving this intergenerational equity. And so they are responsible for setting policy and making decisions. And the next few pages outline some of those challenges, which I'm going to go through and really skip and not spend a lot of time on. But I think one of the key points is, as you look at page 6, which it has the lines, it's really the board's job of a nonprofit to be able to determine what the mission is and what the priorities are of that nonprofit. And then to develop a strategic plan around actually being able to execute against that profit. And what that plan involves is annual budget, a long-term financial plan, as well as being able to focus on setting up your asset allocation and your spending policy. And one of the key challenges really becomes when we look at the following page, page 7. So when you think about this challenge of intergenerational equity, you have assets. That's the endowment pool. That's the investments that you have. Those assets' job is really to fund liabilities. The liability is the operation of the institution. So to fund scholarships, to fund professorships, to fund various component pieces of the operations. So you have an asset pool and you have a liability pool. The asset pool to achieve your long-term growth, when you go down the kind of the left axis here, to achieve your long-term growth with your assets, you have to have inflation plus 5 types of return. So in the U.S. market, if inflation's 8% or 3%, and you need to generate 5% to funding, you have to generate 8% returns. Now, I'm not sure you've ever looked at the U.S. bond market, but today U.S. bonds generate about a 1.8% rate of return. So in effect, what you have to do is you have to take a series of risks associated with investing in higher returning assets, in equity, in private equity, in hedge funds. And because you need to require significant growth, you need to make investments in things that have high levels of volatility. You're not going to be able to actually generate high growth investing in low volatile instruments. And so on one side, on the asset side, you have a concept which really looks at generating high levels of growth by investing in volatile assets. On the other side, you have the funding of your institution, which really grows at the rate of inflation. So, and you like it to be consistent every year. So to fund your operations, you want that to be consistent, to grow at the rate of inflation, to not be volatile. And so as you think about your policy, what you do is you have to balance this growth of your assets with the fact that your liabilities are going to grow at a steady rate and your assets are going to grow at a more volatile rate. Because you're going to be investing in assets that have volatility to them. So the place where this really comes together, and we'll talk about this in a little more detail in a few minutes, is your spending policy. So you have some things you need to think about in terms of your asset allocation, and then the second level is to think about your spending policy. And there's lots of ways to execute on this, but I'll talk about a few of them. As we just quickly move to page 10. Page 10 really takes a look at who is responsible for what, and this is in a U.S. context. In a U.S. context, the Board of Trustees is really responsible for the policy development. They're responsible for the investment policy, in other words, what assets should be invested in, what spending policy you should have, what asset allocation policy you should have, your risk management guidelines, your performance management, and your corporate governance and fiduciary obligations. And then what you do, and in Russia, what you do is you then allocate and provide these overall strategies to be implemented. And that's involving what investment asset classes you should invest in, how you should construct the portfolio, what are the value-added strategies you might want to implement, how you monitor and how you report. So there's two different functions. One is really at the board level, it's really talking about strategy, and really talking about implementation is done by somebody who's close to the concept. So really what you want to do is you want to focus on 4 things in terms of overall endowment management. The first is really thinking about intergenerational equity. How do you achieve intergenerational equity? You do that through thinking about long-term forecasting models, by thinking about your asset allocation policy and thinking about your spending policy. So the chart on page 12 really lays out conceptually how you go about attacking this problem. So if you look at the 3 lines across the top, you see intergenerational equity, you see spending, and you see volatility of spending. So as I described, intergenerational equity, these are the 3 things you're trying to achieve. You're trying to achieve intergenerational equity, you're trying to spend as much as you can, and you're trying to have a relatively small volatility of that spending. Because it's not good to have one year spending a lot of money, next year spending a little money, next year spending a lot, where you have this kind of volatility. So you want to have a relatively smooth distribution. So as we take a look at the three things across the top, intergenerational equity, median spending, and the volatility of spending, we then look at the four things we actually can adjust. The four things along the side are actually those items which you can impact. That's asset allocation, your contribution policy, your spending policy, spending amount, and your spending method. So as you set policy along those four levers along the left-hand side to try to achieve the goals of the three boxes along the top. So this 4x3 matrix is really the challenge that as a policy setter you have to attack. So what I'm going to do is talk about how you think about those and some of the models we use. Now, in the as we think about this, you know, and attack this problem, the first question is, what time frame are we looking at? That's first and foremost. And I mentioned earlier that the period of time that people think about for endowments is how long? What? Forever. Right. So your time frame you're dealing with is a time frame called forever. Now, the problem is people don't live forever. And so trying to put together a policy on forever is difficult. And human nature tends to make people think in short-term cases. And so what we try to do is work through a forecasting model that kind of looks at 20 years. 20-year time frame. That's about as long as humans can actually think, probably longer than humans can think out into the future. So what we try to do is we think through modeling, looking over a 10 to 20-year period. Because again, we're investing forever. The benefit of investing forever is that you can take short-term changes in the value of your endowment if you're able to have significantly higher returns over the long run. And so when you think about an endowment in the United States or an endowment in Russia, the key is to say, I can invest for very long periods of time. I shouldn't have to worry about short-term volatility. And so there are kind of two methods that we use to focus on forecasting long-term returns. One is called and you see it on the bottom of the page, is called the mean variance optimization. And this is an economic model which basically says, let's take a look at what our projected long-term returns are of the stock market, of the bond market, of various asset classes, and then let's review what an optimum portfolio will take. So you need three components to deal with it. The first component is you need expected long-term returns. The second component is that you need, that'd be very helpful, huh? It's hot in here. Or I just am on the hot seat, huh? The second component is you need the expected annual standard deviation, volatility around that mean return. And the third is you need to know the correlation, the relationship between various asset classes. So those are the three pieces. And what you do is you plug it into an optimization model, which then gives you an efficient frontier. That efficient frontier is described as, for a given level of risk, and across the x-axis, the horizontal axis on this, you see the given level of risk. And then on the vertical axis, you see the return. And what you can see from this is I can develop my optimum portfolio mix. That's one way of actually creating a long-term policy. A second is to look at what we call Monte Carlo simulation, which actually takes a look at random changes in future events and takes a look at the distribution of various asset returns relative to that, relative to those various random events. In one case, you tend to get an optimal portfolio. In the other case, you get a series of distributions. We tend to like to use the Monte Carlo distribution. So if we look at the next page, you can see what the impacts, what we do. So what it does is, on page, it's called Forecasting Models Available, page 15. What it does is it says, let's take a look at a series of events and see with that series of events, random events over the next 20 years, what will be the distribution of returns. How many times will we have good returns? How many times will we have bad returns over the next 20 years based on our policy? How many times will we achieve intergenerational equity? How many times will we not achieve intergenerational equity? So it's really a methodology which we're going to go through in a little more detail, which really helps you to think about long term, thinking about the next 20 years as opposed to thinking about the next 1 year or 2 years. And so you see on page 16, what happens is it produces a range of outcomes, you know, some very good years and some very bad years. You can see what those changes in policy will impact. You can look at stress tests, what happens in very bad periods, what happens in very good periods. You can look at how you achieve your long-term goals. And to do this, we have a model, which is a proprietary model, which we use to generate those returns. And so as we go through and we take a look at the inputs and outputs, what we see is what we input is our asset allocation, we input our contributions, we input our spending rate, and we input our spending method. And the outputs are really the distribution of the returns. So we can see our probability of maintaining real purchasing power, and we can see the volatility of spending. Now, before we get into this, what we want to think about is what are the levers of things that you can that you should look at when you put together your policy. The first is, what's your asset allocation? How much money should I have in stocks? How much money should I have in bonds? How much money should I have invested outside my local country? How much should I have invested in my local country? How much in real estate? In the various asset classes that are available. That's really your asset exposure. And ultimately, when it comes down to it, there are probably only 4 important assets you have to look at. The first is investment in equities. That's for growth. Equities will grow at least the rate of GDP over time. And it doesn't matter whether it's private equity or public equity, U.S. equity or Russian equities, you know, emerging market equity. It really doesn't matter. It really is kind of focusing on how much equity exposure you should have. The second area is fixed income. Now, fixed income generally does not provide growth. So when you think of inflation plus 5%, investing in fixed income is automatically putting you behind the curve. Investing in fixed income, you will not achieve your long-term goals. So why put any money in fixed income? Well, the reason is that it is a hedge against deflation. So in periods of time when we have significant economic contraction in local country or worldwide, fixed income will do well. Right, investment in bonds. And one of the things we saw is that bonds during the Great Crisis did very well, while equities did very poorly. So owning bonds was a big help. Long term, it's a drag, but you own it to hedge against recessionary, depressionary periods. The third major asset class is what we call real assets. those are assets that are going to grow in higher rates of inflation. That tends to be real estate, commodity investing, investing in natural resources, investing in certain countries like Russia that have a lot of natural resources, or in inflation-protected bonds. So, again, you own those assets in case you have an inflationary environment. Because equities and fixed income will do poorly in an inflationary environment. The fourth major asset class is what we call diversifying strategies. Those are strategies where the investment is made and it's not correlated, it doesn't relate to the returns of any other asset classes. In the US, that tends to be like hedge funds, maybe distressed debt, different kinds of asset classes which are not correlated to others. The second thing you want to look at is how much liquidity you need. And every endowment has a different draw on liquidity. If you're spending 5% and you have a certain amount of contributions come in, a certain amount of income, you can pretty much calculate how much liquidity you need. In the US, for most US universities, the maximum amount of liquidity they probably need is about 60%, which means you can invest 40% of your investments in things that aren't liquid. In other words, you can't sell them at today's prices. So that includes things like real estate, private equity, venture capital, natural resource investing. And so in the US, what we saw during the crisis is many of the largest institutions had maybe 60 to 70% of their investment in illiquid assets, and they became very strained when the Great Recession happened. And actually had to go out and borrow money because they weren't able to fund their obligations. But generally around 40%. Now, why would you ever own illiquid assets? Assets that you can't readily sell. Any guesses? Excuse me? Yeah, you get the premium. You invest in illiquid assets. It has, at least theoretically and historically, been the fact that illiquid assets generate a higher rate of return than liquid assets. So investing in private equity generates a higher rate of return than investing in public equities. It's probably about 3 to 5% per year. And so one of the benefits of being able to invest forever is that you can take advantage of this illiquidity premium that exists over public markets. And so at Commonfund, we're big believers in this illiquidity premium, and it really has worked pretty significantly. So, but you want to have a limit at how much you can put into that. And so you need to know how much I need daily, weekly, monthly, and how much I can leave illiquid. The fourth level is currency. Now, one of the important things having to do with the investment management business is, and particularly in the US, is almost all the liabilities are in US dollars. So if you are a US university, most of your liabilities will be in US dollars. Now, so why own any currency outside the United States? Well, the fact of the matter is owning currency outside your local currency provides a diversification benefit. It reduces the amount of volatility. So we encourage most institutions to invest, to have currency exposure to about 30% of their total investments, even if all their liabilities are in US dollars. And the last week we talked is what we talk about risk. And that's another policy that you have to focus on. Risk really focuses on how much can I lose in really bad periods of time. And so we call it, I don't know if you know the boxer Mike Tyson. He was a very famous boxer in the United States. He had a very famous quote that went, and this is how we think about risk management: everybody has a plan till I hit them in the face. And so when we think about risk management, we think about what happens when I get hit in the face. How much can I lose in a very bad situation? And is that more than my institution can stand? If it is, you have to really go about and adjust your overall policies. So these are really the 4 levels of policy that every institution should have and think about at the trustee level before they actually do any investing. So what I wanted to do was take a look at some of these Monte Carlo simulations. And it's going to be hard to do because they're not in color, but if we turn to page 20, what we want to look at, 21, sorry, what we want to look at is really 3 different asset allocations. The first one on the left is for your endowment, what you have is 70% of your endowment invested in stocks, and this is thinking about U.S. markets, and 30% invested in bonds. So that's one portfolio. That's one asset allocation. The second is what we call diversified. And what that has is a higher percentage invested in asset classes outside of stocks and bonds. So what you can see is that 7% is invested in real assets. As I said, real estate, natural resources, commodities, and the like. And 18% is invested in relative value hedge funds or diversifying assets. And within the equity asset class, a certain percentage are invested in private equities. And the last we're going to look at is the highly diversified, which is we have 20% in hedge funds, 12% in fixed income, so less in fixed income, 51% in equities, private and public, U.S. and international, and 17% in real assets. So what we're going to do is we're going to take a look at those 3 portfolios, and we're going to run them through our Monte Carlo simulation. And we're going to see what the outcomes look like. So if you turn to page 23, what you see is 3 mounds: a dark gray, a light gray, and a lighter gray. These are the colors I have. So I have some advantage over dark gray, light gray, and lighter gray. But what we do is we say, okay, let's take these 3 asset allocations and let's run it through our Monte Carlo simulations. So let's look at 1,000 different future events. Good markets, bad markets, high inflation, low inflation, and randomly look at different futures. And let's see how this asset allocation will perform. And so what we've got along the horizontal axis is the distribution of nominal returns. What we have along the vertical axis is the number of times those nominal returns were achieved. So the one in front, what I think is the darkest gray, is actually the distribution of that 70-30 kind of very traditional asset allocation. So straight stocks and bonds. The next one, the one slightly behind that, is the more diversified, and the one in the far back is the most highly diversified. Okay. So what you can see is that that distribution of returns is very different for the three. That as you have more diversifying assets in place, where you end up with is moving to the right. If you look at the boxes on the far right, the median return of the kind of asset allocation that's more standard is 8.3. The more diversified is 8.7 median return, and it's 9.4 median return for the most diversified. So what you can see from this argument here is that as you diversify, at least from our modeling, as you diversify your assets into more asset classes, and as you take more illiquidity risk, you increase your long-term return. Again, this is the average of all of these over a 20-year period. When you add spending to this, what we get then is on page 24 is you can then see, in this case what we do is we spend 5.6% per year, and we use the higher education price index as the deflator. What you can see is that spending 5.6%, again, what we look on the x-axis, what we're looking at is the change in real value. On the y-axis, what we're looking at is the number of times it occurs. The key is to look over the circles over on the far right. If you spend 5.6% per year and have no gifts, and you use the higher education price index as a deflator, what you end up with is a 19% chance of achieving intergenerational equity. That means out of the 1,000 events that we look at in the future, 190 of them will be, you'll actually have achieved your long-term goal. As you get to more diversified, you look at the last blue circle, you get to about 29%. None of those work, right? To create a policy where you achieve intergenerational equity, your main goal 29% of the time, is not a good outcome. So what we have to do is we have to look at some different changes to this. The first is we want to look at giving. Looking at this hypothetical $250 million endowment on page 26, if you just add, and what we see is the same analysis, but in this case with zero contributions, we're at the 29%, right, 28.9%. If you have $3 million of gifts per year, you get to 49%. And if you add $6 million of gifts per year, you get to 66%. So gifts are as important as investment returns. And you can't, if you spend 5.6%, which is too high, you cannot achieve intergenerational equity without at least having a chance of intergenerational equity without having significant gift flow. So one of the things we we tell our clients all the time is getting contributions into the portfolio is as important as good investment returns. So as we look at this chart where we talk about the four levers, on page 27, if you increase your asset allocation, increase diversification, increase risk, it has a positive impact on intergenerational equity. It has a positive impact on spending because you have higher levels of growth, and it reduces volatility. Impact of contributions is exactly the same as the impact of investment returns. So one of the arguments we make with a lot of our clients is that you should be spending as much on generating new contributions as you spend on your investment management, because it has the same impact. And so many of our clients have giving offices that may have 50 or 60 people. I'm sure you've seen them, working on development.
Even 100.
Even the very large ones have well over 100. So if we go to page 31 quickly, what you can do is you can look at the impact of changes in spending. So same analysis. Again, look at over on the right-hand side. If you have a 6% spending rate with $3 million of gifts in a highly diversified portfolio, you have a 40% chance on the far right of achieving your long-term goal. 6% spending is too high, unless you have a lot of gifts. And so if you look at 5%, you're at 62%, and if you go to 4%, you're at 80%. So we recommend most of our clients be between 4 and 5% spending. Once you start getting to 6%, you have lots of challenges in terms of achieving intergenerational equity. I'm going to skip some of the next slides and talk about kind of where people are, where universities are today. If you go all the way to page 39, because I've got 5 minutes plus 10 minutes for questions. This takes a look, this chart on page 39 looks at the returns of various universities by size. And so it's broken up. You can't probably see it in black and white, but I'll try to go to shades of gray here. The numbers. So if you take a look at along the x-axis, what you have is size. So you start on the far left with total institutions, and you work your way from the largest endowments to the smallest endowments. So those institutions, the first column is those institutions which are over $1 billion of endowment assets. The next is 500 million to $1 billion, moving down. The first line, the lightest line on here, is the return for fiscal year 2012. And as you can see for fiscal year 2012, the average endowment in the U.S. lost 0.3%. Not a particularly good year. You look at the next line, which is the dark black one, is the 3-year returns, where the average return was 10.2%. And you look at the 10-year period, the average return was 6.2%. Now comes the test. If you look at the last 10 years, did the average endowment achieve intergenerational equity in the United States?
The answer is no.
What?
No?
The answer is no. Again, we have two choices, yes and no. I should say there's a third answer, is it depends. But by and large, the answer is no. It depends, because if you had a lot of gift flow coming in that doesn't go into returns, you may have actually done better than intergenerational equity. But in general, if you're spending 5% and inflation is 2%, 2 to 3%, you have not achieved your long-term goals. If you look at the over $1 billion, the next column, what you can see is that the over $1 billion 10-year return is 7.6%. And you look at the under $25 million endowment, the average return is 5.7%. Now that average return is, it's 101.9% higher, average return per year. So the average large institution came close to achieving intergenerational equity, where the smaller institution did not. The next page looks at the dollar-weighted allocation of assets. This will come as a shock to many. Page 40. The largest allocation of the average university in the United States is to alternative assets. 54% of the assets invested by U.S. endowments are in alternative assets. What are they? It's private equity, it's venture capital, it's natural resources, it's distressed debt, it's hedge funds, it's commodities. Did I say real estate? Real estate. This has been the fastest growing segment of the investment business. As you can see, only 15% are invested in domestic U.S. equities. Only 16% are invested in international equities. Everything else is in this pool called alternative assets. And so that's really what's driving the returns. Why do people do that? Because they get higher returns and they have less volatility. And you can see on page 41 that this has been a substantial growth. Fixed income, which is the third line, starting the third line, has come down. U.S. equities have come down. International equities have remained, has gone up slightly. But the biggest area of growth for U.S. endowments are people putting money into these alternative investments. And the reason is that you can generate higher rates of return and have less volatility. And the fact is, it has worked. If we take a look, for instance, at the last 10 years ended June 30th, 2012, the average institution that had investing in private equity returned 8.5%. versus the stock market, which was 5.3%. So private investing outperformed public investing 3% per year for 10 years. That's why people are putting money into the alternative space, and so that they can, that's the only way, when you look at those long-term charts, that you can generate that higher rate of return that you need to hit inflation plus 5%. And the next page looks at the funding, at the spending rate. And this looks at the spending amount relative to the year-end asset value. And as what you can see is that the spending rate has bounced around quite a bit. That when when markets are down, the spending rate tends to go up. When markets go up, the spending rate tends to come down. But by and large, we're somewhere every year between 4% and 5% on average. And so that really is the kind of approach. So just in quick summary, a couple of takeaways. First, this is really hard to do. I've been doing it for 30 years. Once in a while, like 1998, you think you have the answer when the markets are really doing good, and you think you're really smart, but you're really smart because the markets are doing good. It's a very hard job. The concept of achieving purchasing power parity, of achieving intergenerational equity, is really difficult. And in fact, most institutions over the last 10 years have not been able to do that. And so focusing on setting that asset allocation policy, that liquidity policy, that currency policy, and that risk policy become paramount. And then finding somebody that can execute against that. But the key is to make sure that you focus on the long run. If you focus on the short run and worrying about what will happen the next 1 week or 2 weeks or 2 months or 2 years, you're going to end up in a situation where you're not going to be able to achieve your long-term goals. You have to be prepared to absorb the volatility that comes along with investing in risky assets. That's the only way you're going to be able to achieve the goals that you set out for yourself. And obviously, don't spend too much in good times, and save for the bad times, because it is easy. And what we saw in the U.S. is during the really good market days in the late 90s, institutions like Harvard overspending. And then comes, 2008, and all of a sudden you're in a situation where they're really challenged and they have to cut a lot. So it's a really hard job. nonprofits, it's not easy, and setting policy becomes the critical piece about doing it, and sticking to the policy, because it's very easy to do exactly the wrong thing at the wrong time. So with that, I will open it up for questions or comments, more importantly, comments.
Thanks a lot. My name is Verne Седлачек from investment management department. I wanted to ask a question about the strategic allocation, asset allocation. Considering we are aiming for a long strategic period, how often board of trustees revise this strategic allocation?
That's a great question. That's a great question. Generally, what we say is that you should look at your strategic asset allocation once a year, and probably shouldn't change it. But you should look at it once a year to make sure you're continued to be aligned. At Harvard, what we did is once a year we sat down with the board of trustees and we went through the asset allocation, and made very few changes from year to year. There may be slight adjustments here and there based on what might change our long-term outlook. Today, for instance, we advocate very strongly that people should reduce their exposure to fixed income. The reason for that is it's, at least in the U.S., and I think most of the world today, fixed income has a negative real rate of return, that the rate of return you receive is less than the rate of inflation. And therefore, from a longer-term strategic standpoint, we think that you should reduce your exposure to fixed income strategically, but not to zero. You may reduce it by 2 or 3%, but not reduce it to zero. So the answer is you should look at it annually. Probably very seldom make any changes to it, but only when you really have some major change in terms of valuation.
I've got one more question for you. Alternative strategies is very big amount of different strategies, hedge funds, real estate, and so on. And it would be very interesting to see a breakdown of these strategies. I mean, as I understand, hedge funds are very different in their performance returns with real estate or distressed debt. And I think it's not really right perhaps to put private equity together with them.
Let me see if I have the breakdown handy. Okay, are you ready? So, as of June 30th, 2012, of the alternatives, so 54% in alternatives, and this is the percent of the 54%, so it adds to 100. 25% in private equity, 36% in hedge funds, 7% venture capital, 13% private real estate, 15% energy and natural resources, and 4% distressed debt. So fairly balanced between the various alternative asset categories.
Actually, I expected it to be a portion of real estate to be much bigger.
I think that's a really good point, and historically it has been. In 2003, it was about 11%. a couple things have happened. Most importantly, real estate got clobbered in the U.S. So there's been a combination of write-downs, right, and not new investment going into real estate. And so it certainly, if you go back 10 years, it was higher, but it wasn't a substantial portion. Hedge funds was a much bigger portion if you go back 10 years of that alternative bucket. As I said, real estate has had a difficult 4 or 5 years in the U.S., and so I think there's been a reduction in terms of the valuation because everything gets marked to market in the portfolio, and there's been less interest of endowments and of investing in that direction because of the illiquidity. They may have spent more time going into public real estate investments versus private real estate investments. With respect to, the question was, how do you go about investing in some of these things like hedge funds? They're hard. It's hard. Generally, there are lots of advisors in the U.S. out there, including us, that actually help universities find the right hedge funds to invest in. Generally you want to have, in almost all of these alternative asset groups, you probably want to have 5 to 10 different managers, so you don't have exposure to any one manager that's too great. And so you really need to find, have some expertise to be able to find the right managers.
As I understand, the majority of hedge funds still are still directional, so there's some exposure to that market. I mean, as I understand, the majority of hedge funds, they're not market neutral. They still got some directional view on the market, so still some exposure next to market.
Yeah, I mean, there are really multiple types of hedge funds, and generally we classify funds which tend to have net exposure to markets as equity. So if you're 40% exposed to equity, that's really equity hedge fund exposure versus kind of quote unquote strictly market neutral hedge fund exposure.
Есть ли у кого-нибудь еще более простые вопросы, чем есть? Okay, I would ask you a question. As I have a lot of conversation about endowment, the first question usually is it worth to have endowment? And maybe it's better to spend all donations on everyday basis, not to invest where can I lose money or something like that. And your presentation begin with that we don't need to have endowment, really, because you show that when you invest $100, you will receive in 40-50 years, you will receive 74. And then several times you show that university spends more than they can earn if you take in account inflation. What would be your answer, having these figures, having these options, whether it's worth to have endowment, or maybe it's really better to spend all donations in everyday basis? Right.
Well, so the figure that the chart that I went through really looks at a very plain investment philosophy with a very high rate of spending. So, in terms of talking to donors, the answer is first, the investment approach we need to take needs to be somewhat different from that plain, more plain vanilla approach, and you need to see other asset classes investing in that. Second, you may not spend 5%, may spend less than 5%. Third is, you want to keep getting gifts in, because if you look at it without gifts, if you add 1% of gifts a year, that pushes you back up in terms of more gifts to endowment. So that is from the kind of pure financial standpoint. But from the operation of the institution standpoint, having a capital base for the institution has more benefits to the institution in terms of having flexibility in terms of its approach, permanence in terms of its ability to provide professors, to provide buildings, permanence in terms of providing scholarship, and the ability to be more flexible in terms of the approach elsewhere. So having endowment is not just about the distribution, the annual distribution. Having the endowment really is about the stability of your organization. And the key is you want to be able to prove to your donors that you have a plan to be able to exceed that inflation plus 5%. And that, you know, what Harvard does and Yale and the other big ones is they go out.
But the problem is in Russia inflation is much more than 2%. Yeah, you know, and it's if we ask a asset management company, and I asked them today in the morning in the Invest Funds Forum, and during all our relationships with the asset management company, can you provide me plus 5%, inflation plus 5%? All of them are hesitating about this, you know, and it's rather difficult.
It is difficult. It's difficult everywhere. It's difficult in the U.S. But you really have to lay out a policy which gives you the best opportunity to achieve it. Because there's, you know, I can give you an asset allocation policy in which I can guarantee that you will never achieve inflation plus 5%. That's not something that you're going to want to invest in, right? I can invest in U.S. bonds, and I will guarantee you'll never achieve your long-term goals. All I can do is put together a policy which helps the ability to achieve that intergenerational equity, gives me a chance, because I can't guarantee it to my clients of achieving inflation plus 5%, even with the flexibility that we have. All we can do is try to lay out a policy that gives us that ability. And I know you have more restrictions in Russia in terms of how you go about investing. And, you know, quite frankly, you know, spending 5% may be too high as a tactical method in terms of long-term being able to preserve an endowment. The one key from a donor's perspective, so the donor has a choice. He gives you 100 rubles today, or he can give you 5 rubles for the rest of his life, right? That's the same impact, right? Giving you the 100 rubles today allows you to pool it with others to have better investment returns than he could get, and gives you flexibility and financial stability around your institution that you don't get if he holds on to that. So I
Not finish.
oh, thanks.